Hello, my name is Glenn Livingston. I'm with Livingston Financial Group. Worked out really well, I guess, when I interviewed for the company as a joke. But my uncle started the company in the Baltimore, Washington area back in the 1980s. And Michael and I joined the company about 20 years ago now. And we've been working with federal employees for well over 15 years. And during that time, we are experts in federal benefits, but we are also fully licensed financial advisors. And that's why we're here talking to you today. It's a really good combination. There might be a handful of federal employees in the Baltimore, Washington area. A little bit about our organization. We are also certified in federal benefits for not just, proclaiming that we are. We actually, taken all of our advisors across the country. So no matter where you may be, whether it's, California, here in Maryland, Baltimore, Washington area, New York, Florida, whatever, we have a Livingston advisor near you. And all of our advisors are fiduciaries, licensed financial advisors, and they all have had to pass that test to become certified in federal benefits as well. So we're happy they're here joining us today. Today's conversation is going to be on life insurance and long-term care insurance. Not people's favorite things to talk about, but two absolutely vital things that need to be discussed. If these things are neglected, these are probably the two biggest threats to your retirement, is not protecting yourself from either passing away or needing some sort of extended care that can either way can just devastate your family financially. So as little fun as this is to talk about, this is absolutely vital, and it's really, really important information. So let's get right into it. And oh, by the way, if you have any questions, with so few of us online today, feel free to unmute. You can go to the chat box as well, but you can also feel free just to unmute and ask a question if that's something that you want to do as well. So FEGLI, that is your group life insurance that you have with the government. When you first joined the government, you most likely signed up for everything. They said, just sign up for everything. You can always drop it later. You have your basic coverage, your three options A, B, and C, that kind of stuff. Your FEGLI started out really cheap when you started. You weren't making a lot of money, and sure enough, it didn't cost a lot of money. But now if you're later in your career, you're making good money. In your 20s and 30s, it's still pretty cheap, but as you get into your 40s, it starts crossing over into the more expensive territory, and in your 50s, it starts getting really expensive. But we're going to go through all those details together. And the reason why it gets more expensive, as you can see over here, it's 5-year guaranteed renewable term. What does that mean? That means every 5 years, the cost of your options, A, B, and C, go up in price, whether you've gotten healthier, more sick, or whatever. The fact that you are 5 years older, it's guaranteed renewable, so they can't cut you from the program. But if you're healthy, you are paying for all the unhealthy people. So as you can imagine, excuse me, the cost gets more expensive as you get older, and it starts actually kind of growing at an escalated rate in your 50s for that reason. They never kick you out, but they do price you out of some of the options. And again, we'll go through all that detail in just a minute. So your basic benefit, this one, it acts more like a whole life policy. Remember this with FEGLI before we get started. FEGLI has been around so long, it is kind of a dinosaur. It's still effective, don't get me wrong, but some of the numbers are kind of odd. They're somewhat negligible today, but back in the day, it meant something. So you think about this, people used to make $5,000 to $10,000 a year in the 60s, and their house cost maybe $25,000 to $30,000. So when you see something where FEGLI says the salary is rounded up right here, plus $2,000, that plus $2,000 was a bigger deal then than it is now. But today, don't get me wrong, I'm glad they add 2,000 instead of subtracting it. But overall, it's somewhat negligible in today's dollars as far as protecting your family upon your passing. Now, the cost of FEGLI for basic doesn't go up because you get older. The cost goes up because you make more money. So the cost is 15 cents per pay period, so every 2 weeks per 1,000. So you'll notice you should be getting probably right close to getting your first pay period of the new year. You'll notice that your FEGLI has gone up. Why? Because everyone got a significant COLA last year. So there are more $1,000 units. So therefore, there's more 15 cents per pay coming out of for your FEGLI basic benefit. All right. So that's the way basic works while you're employed. It's essentially your salary is the way you want to think of it. Now, upon retiring, there's two things you fill out when you retire. You fill out your 3107 if you're a FERS employee, and then you have a FEGLI form called the 2818. You fill that out. So you don't have to make any of these choices until you retire. But when you do retire, there are 3 choices you can do with your FEGLI basic. The one that probably 95% of the people choose is the 75% reduction. And here's why. Upon retirement, if you choose the 75% reduction, your cost stays the same. Because remember, in retirement, everything comes out on a monthly basis. So 15 cents per thousand per pay is about the same as 32.5 cents per thousand per month. So the cost stays the same. At 65, it becomes completely free the rest of your life. But between age 65 and 70, it reduces 75%. So think of it this way. If you make $120,000 a year, or if your benefit's $120,000, you're going to pay the price up until age 65. 65, it's free the rest of your life. But between 65 and 70, every month it comes down a little bit in a death benefit until you end up with 25% of the cost, which is $30,000. So you'll carry $30,000, or essentially kind of like a small paid up whole life policy the rest of your life. Most people choose that because it's by far the cheapest. The cost is the same. It's free. You've already paid into it all these years. And if you're retiring, if you're filling out retirement paperwork and you still have FEGLI Basic, this is the one that everyone does for the most part. The 50% reduction, I have never seen anyone choose this one. So you'll notice when we do our presentations, we try to give some high level advice. So don't take anything I said and you apply to you. I've never met either of you. I don't know what's best for you. Don't go out and just get rid of things because I say things here. When it comes to insurances, you need to do an analysis or sit down with someone. It could be us or anyone else that is a professional, or you can do the analysis yourself, figure out what you need, how much you need, why do you need that amount? All right. Then you get the new coverage in place, and then you can replace the FEGLI. What you never want to do is you never want to drop something and then apply for new coverage. All right. The life insurance gods are fickle. Your cholesterol will go up for no other reason than you dropped your previous life insurance. I'm kidding, but you get the point, right? You don't want that to happen. So my idea here at these high level recommendations or high level discussion points are to get you thinking, not to necessarily to have you go out and do something right away or cut something immediately. All right. You need to do an analysis on what you need, how much you need, why you need it, put something in place before you drop something. That's the way it always works with insurances. So I wanted to say that before I start getting too much into the reductions and some high level recommendations. All right. So back to our 50% reduction. I've never seen anyone choose this. Why? You notice the price goes up by 300%, up to 92.5 cents per thousand. And you'll notice instead of reducing 2% until it's a 75% reduction, it only reduces 1% between 65 and 70. And so you carry 50%. All right. So if you're 120, instead of covering 30,000 for free the rest of your life, you're actually going to carry 60,000 at the tune of 60 cents per thousand, which is twice the rate of what you paid for of your 75% reduction. So in today's dollars, you carrying 30,000 versus 60,000. I don't care if it's even 40,000 versus 80,000. That extra 30, 40,000 is somewhat negligible in protecting. You're talking about really protecting your spouse or your kids or family. That 30, 40,000 is not negligible, and it's not cost effective to do that. Now, that other 5% of the time, it's pretty rare. But if you're uninsurable and you need to have insurance, you still have kids in college when you're retiring, or let's say you still have 150, 200,000 on your house, and you've been diagnosed with diabetes, or whatever it might be, right? Cancer, God forbid, but you're uninsurable at this point. This is expensive, the no reduction, but it's affordable expensive. And what I mean by that is you'll notice it's $2.15 per thousand. So if you had $150,000 in coverage, it would be, a little over $300 a month. Now, that's expensive for life insurance, but it's affordable. And you would carry that $150,000 if you wanted to for the rest of your life. At age 65, it does reduce in price. So this might be the only insurance in history that reduces at the age of 65, even though you're carrying the full boat coverage. But you would be able to get a little bit of reduction and still carry, let's say, your $150,000 for life. Now, when you choose something in retirement, you're never allowed to increase it, but you can always eliminate it. So what does that mean? So if you did need to choose the no reduction because you're uninsurable, you could do that. And then let's say at age 70, you just want to get rid of it because you don't need it anymore. The house is paid off, kids are out of college, or 65, 60, whatever that case may be. You can always drop it in retirement. You can't add to it, but you can always drop it. All right. You can't modify it in the sense of you can't switch from the 50% reduction to 75. There's no modifying things, or the 75 to no reduction. You can't do that, but you can always drop coverage in retirement. Okay. Again, please, if you have any questions, feel free to interrupt me. All right. Option A, this is left over from back in the day when houses used to cost, $30,000, $40,000. Today, it's inexpensive, which is great, but it's a $10,000 additional benefit. If you have it, that's great. It's not that expensive. Keep it, get rid of it. Again, you're really not protecting your family with this. Option A. You can see the cost. Why does the cost go up through the years? Because you're getting older. This is where you start getting that 5% guaranteed renewable term. But at the same time, as the cost is going up, it never really gets that expensive. And in retirement, this automatically reduces at age 65 from $10,000 to $2,500, and it's free the rest of your life. It's free $2,500, but it is free. So most people, if they're retiring at 57, 58, that kind of thing, they'll go ahead and drop this. You don't have to. Again, not that expensive, but most people do at that point in time. If you're 63, if you're in your 62, 63, 64, even above 65, definitely keep it, but you might as well keep it at that point in time because you might as well get the $2,500 benefit for free the rest of your life. But you can't go wrong keeping it. You can't make a wrong decision by getting rid of it. It really is somewhat negligible. All right. It's not too expensive. Now, this is the one. This is the one we need to pay attention to. So this is the one that makes FEGLI cost prohibitive. This is also the one that really protects your family while you're young. You'll notice if you do 5 times your salary, back in the day when you made $50,000 a year, you had $250,000 in coverage. That's great. There's not that many $1,000 increments at the time, and you're young, so it's really cheap. That's a benefit too, and it's not that big a deal. All right. Now all of a sudden you're making, $150,000 a year. Just to make up a number, 150 times 5 times your salary is quite a bit of money. What is that? $750,000 in coverage, and you're older now. So you're no longer paying 2 cents per thousand. You have $751,000 units, so to speak, but you also have, it's also considerably more expensive. This starts getting a little bit more expensive in your 40s. And by 50 is about the time, by 50 is usually when you want to start looking to get rid of this or replacing it with something else. And again, I want to reiterate, you replace means that you get something else in place, and then you would consider dropping this at that point in time. Okay, we'll go over the exact costs in just a minute with an example, and I'll show you how the costs just are off the chart. You're going to end up dropping this anyway later in life, is what's going to happen, because it's going to get cost prohibitive as you start approaching age 60. All right, it's great. Well, you're young, it's cheap. It can actually be cheaper than private insurance when you're young. But as you start getting in your 40s and 50s, it starts getting more expensive. And you might be better off with a term or a permanent policy. We'll discuss more of that in a minute, some private industry options. Okay. When you retire, you can either keep the whole thing with no reduction, or you could choose 100% reduction. What does that mean? That means you keep your full boat coverage up until age 65. At 65, it is free, but at age 70, all your coverage is gone. And it's really pretty expensive trying to get to age 65. So it's not that cheap. Okay. But it's all gone. There is no 25% left. It's 100% gone. And then the no reduction here just becomes crazy expensive. As you can see here, it begins at $1.56. And it goes to $5.20 per thousand per month. So as you can see, you start getting into $500, $800, $1,200 a month in coverage pretty easily here with the option B. All right. Again, it's meant to price you out of the market. It's meant to protect young federal employees, but it is not meant for you to protect your family as you get older going into retirement. They won't kick you out, but they'll price you out. Option C, this is family coverage. You can't get more than $25,000 on your spouse, and you can only get up to $12,500 per child. A lot of people will drop this upon retirement. You don't have to. You can keep it. It's not terribly expensive, but a lot of people will drop it upon retirement. Why? Because when you retire, your kids are older, and you also typically have enough money to cover funeral expenses. Unfortunately, I've had to cover a couple of those in the last couple of years. My cousin Michael and myself are business partners. If you've seen Michael in the other seminars, but a funeral is probably going to be in the $15,000 to $25,000 range, and you can keep your coverage if you want. It's not too expensive. Again, you can't go wrong keeping it. You can't go wrong by getting rid of it. It's up to you, however you want to do that. I will say this: there is no way to drop your kids off the policy. One of the reasons why people get rid of it when they retire too is that your kids are no longer covered after age 22, but there's no way to drop the kids and keep your spouse. At least I haven't heard of any. unless something came out in recent laws in the last year or so. As of the last time I did this seminar last year, there's no ability to just drop the kids, even though they're above age 22. So that's kind of, most people just end up dropping it. But again, and because they can afford, if you're retiring, hopefully you can afford $20,000. You may not want to, but hopefully you can afford to be able to do that. All right. Any questions with your FEGLI insurance before we start getting into a case study? All right, good news, good news. All right, so one of the things that we do is we try to do case studies. All right, this is Joe Sample. I chose that name a long time ago because he's one of my favorite jazz musicians, but also it's a sample, so who knew? As you can see here, Joe Sample has full boat everything. I mean, he has got everything going on. His basic FEGLI coverage at 54 is $114,000. He has no option A, so doesn't have that, but it's not that expensive anyway. He's got the 5 times option B, 5 times option C for spouse. Total coverage is $699,000 at age 54. And he's currently paying $180 a month. All right. A little pricey for a term policy, but not the end of the world. Okay. Now, remember, it's 5-year guaranteed renewable terms. So every 5 years, your A, B, and C options go up in price. So at 55, 60, 45, 50, 55, 60 goes up in price. Okay. So at age 55, you can see his monthly coverage goes to $301 a month from 180. Now it starts getting pretty expensive. Affordable expensive in the sense of if you're uninsurable, maybe you have to do this for a few years, but really not something you want to carry on into perpetuity for the rest of your life. And you can see here, by the time we get to age 60, it goes up in price again when he retires. At 57, it jumps from 313 to 571. That's retirement. That's what happened there. And then of course, at age 60, it has another jump. So essentially from 54 to age 60, it went from $180 a month to almost $900 a month. Okay, so that's what I'm talking about. You're going to end up dropping this anyway. And this is really 95% of the cost of this thing, or at least 90% of the cost of this thing is driven by option B. Nothing else is really that expensive. Your basic isn't that expensive, option A and option C. This is all option B. But you can also see option B is the bulk of the coverage as well. All right, of the $741,000 in retirement, $595,000 of that is coming from option B. And that's what you're paying for right there. So option B, again, just as kind of proof that they will price you out. Now, things you can look at doing, you can always look at reducing option B coverage, maybe from a 5 to a 3 to a 1. You could do that. Or maybe if you're uninsurable, you have to keep your option B and then you drop it. You can look at doing that. Different ways to go about doing this. So again, talk to a professional. You can do your own analysis, talk to a professional, but a plan needs to be put together that includes your pension, TSP, debt, and all those kind of things, which goes into our next slide. So how do you want to do this? Well, you calculate FEGLI cost and you want to compare with personal life insurance funding. That's all there is to it. Your health plays a role in this. Your age and your health absolutely play a role when it comes to private life insurance. Most of the time, private life insurance is cheaper, like 95% of the time, especially once you're over age 50. You break even in your 40s. The benefit of getting this in your 40s, even though you break even on it with the private plan, is that your prices are locked in for the term or the rest of your life, and they're locked in at lower rates. If you wait till your 50s, it's still cheaper, but you're not locking in at the lower rate. So let's look at this. A term may be an option, but the problem with the term is what? One day the term runs out. Okay, so you buy a 20-year term at age 55 and you celebrate your 76th birthday, all of a sudden your spouse has no more life insurance. You're not covered anymore. So you pass away as a federal employee, there's no pot of money for them anymore. And that might be okay as long as you have a sizable TSP and manageable debt. So you need to have a plan. A term is the cheapest out there, but believe it or not, insurance companies make more money on terms than they do permanent. Permanent being a whole life, which we really don't do that anymore. Most likely it's some sort of universal policy where it's variable universal, guaranteed universal, indexed universal, those kind of things, right? But permanent life, it just means it lasts a lifetime, but they actually end up making more money on term policies because last time I checked, we're all pretty much guaranteed to either pay taxes and pass away. So they're going to pay out your death benefit with the permanent policy. So they're more expensive, but they make less money. Term policies, 1,000 people pay in and 30 people die, whatever that number might be. They have that actuarial tables down. They actually make more money. So a term saves you money, but the term may or may not be your best interest depending on what you're trying to do. And it all comes down to, well, you have to answer this question. This is the best question to think about. If I pass away, a month or two after my term policy expires, I expire, let's say, can my spouse maintain a similar quality of life? All right. They don't have to get every nickel that you're getting with the two of you together. But the key is, can they maintain a similar quality of life? All right. You don't want them to have to go out and sell the house or condo, cut back on everything, can't get the car fixed, move in with the kids, that kind of stuff. All right. Can they live a quality lifestyle upon your passing if the term expires and then you pass away afterwards? All right. If not, you may need to look at using what they call, I said permanent, that's just a word for it lasts a lifetime. Again, more expensive, but no matter when you pass away from this life, someone somewhere is going to get a tax-free death benefit. All right, so it's just something to consider there. You can also leave a legacy for this. So let's, going into long-term care. So an idea of that would be, let's say the cost of doing, and this ties into your survivor benefit as well. If you remember, if you were part of the seminar before where Michael talked about your survivor benefit, this ties into that as well. Can you do a 25% survivor benefit and then do a term, or do you need to do a permanent lifetime policy? I don't know. And that really depends on your financial situation. Talk to an expert. This is where you talk to someone. Again, it could be us or anyone else who's an expert in your federal benefits, because they're going to want to calculate your pension, survivor benefits. You're going to look at your debt situation, your TSP situation with kids, parents, all kinds of things going on. Are you looking to move, downsize? All right, you owe 300,000 on your house, but your house is worth 800,000. Are you looking to sell it? Take that 500,000, pay cash for your next place. All that goes into a financial plan, and that all needs to be done well before you retire, so you can start making these choices then. You don't want to make this choice 6 months before you retire at age 57. Okay, so this is something you need to begin earlier than that, because you need to start getting things in place. Okay. All right, let's look at long-term care. I apologize for moving on a little before then. Long-term care, if you thought life insurance wasn't fun, long-term care is really not fun to talk about, but this is probably the single biggest threat to your retirement. If anything's going to destroy your retirement and really mess it up, it's going to be long-term care. Either you're taking care of parents, God forbid you have to take care of kids. We've seen that happen a couple of times. Could be car accidents, could be diseases. But look at this statistic right here. 70% of people over age 65 will need long-term care. All right, that's not fire insurance. That's not automobile insurance. Going to have a fire in your house is like 1 in millions. Getting in a huge car accident is 1 in, I think a couple hundred thousand, something like that. Or really horrible car accident. This is a 70% chance. And if you consider you and your spouse together, it starts getting around 80%. There's like an 80% chance that one of you would need long-term care. And as we all know, especially if anyone who has been through this with a parent, this stuff is crazy expensive. So the odds of using it is almost certain, especially if it's one person of the couple. And then when you do use it, it can absolutely take you broke, let alone if you have to take care of a parent before you even get to that phase. Okay, so let's take a look at this a little bit more in detail. What is long-term care? Well, long-term care is essentially doesn't have to be this. Did you know, by the way, too, that I want to say around 30 to 40% of people in long-term care facilities are under the age of 65? An example of this, my dad was a pastor. He passed away a couple years ago, but at age 65, he fell off the roof of the church. I don't know why he was up there at age 65, but just to give you an idea, and broke his back. And he didn't think he was going to live, and thank God he did, and didn't think he was going to walk, and thank God he did. But he spent 6 months in a nursing home on the rehab side, living there, learning how to walk again. And that doesn't have to be falling off a steeple. That could be any accident. Imagine a car accident, anything like that. So it's not just people who are 82 years old in the future. This could also happen while you're younger and can happen for a period of time. It doesn't even have to be the rest of your life. But essentially, if you need long-term care, you need ongoing services and support for chronic health, condition, or disability. Okay, there's 3 levels of care. We all know about the nursing home. That's the skilled, 24-hour care. Intermediate care, that may be assisted living. Okay, and then there's personal care. Someone comes out to your house. So it can be provided in a lot of settings. It can be provided at facilities. It can also be provided in your home. Okay, so the whole goal of long-term care is to keep you in your home longer. You want to be in your home, you're most comfortable in your home. It is cheaper for you to be in your home. And the insurance company, the government, you want to be, we're all on the same page this time. Everybody wants you in your home from a cost perspective and your comfort perspective. However, sometimes it goes from in-home care to assisted living. Now, women, this is especially important for you. You'll notice that when you look at the statistics for nursing homes, it's like 60-40 women to men. But if you look at assisted living, it's closer to 90%, maybe 80 to 90, depending on which location, but pushing 90% women to men. And the reason being is men, we pass away earlier than women. And when we need assisted living, a lot of times our wife will take care of us, okay, because they pass away usually 3 to 4 years after us. They will take care of us. And then what happens is they can't take care of us anymore, and we go to the nursing home. So a lot of times it's at home for men, then nursing home. Doesn't have to be. Women, and this happened, Michael and I are cousins, our dads are brothers. And so we share 3 sets of grandparents, right? All 3 grandmothers spent quite a bit of time in assisted living. 2 of them went on to nursing home towards the end of their life, but all 3 can spend a considerable amount of time in assisted living because their husbands had passed away and they needed care. They had independence, they had their own room, but they needed help. They did not need to be on their own. Okay, so ladies, this is really something that's more geared towards you if you're going by statistics. Anything can happen to anyone at any time, but if you're going by statistics, this is a lot of women do the assisted living thing. Adult daycare, this is actually not a bad thing. Adult daycare is maybe you move in with your kids, they go to work during the day, and instead of you sitting in your house alone or their house alone, they may take you to adult daycare. I hate the name of it, but it's actually fantastic. The number one threat to your mental state as you get older is being alone in your house all the time and not getting out and not having any activity, not keeping your mind and body sharp, forcing you out of your house, forcing you to do activities, forcing you to go somewhere where you can do games and conversation and interact with other people. Again, this is not a nursing home, so these are not people, out of their mind kind of thing with, horrible at the tail end of Alzheimer's and dementia and things like that. But doing that can actually extend your quality of life for many years. Again, we saw that using personal examples. We saw that with our grandmothers in assisted living. They were starting to deteriorate. They go into assisted living, and all of a sudden, mentally and even physically, they started getting a lot sharper, and it extended the quality of life for some time before they passed away years later. Okay. And finally, there's a nursing home, and we're unfortunately all familiar with what that means. That means you need 24-hour care. You just do. Okay. Cost. This is actually at this point in time, I want to say it might be a couple of years old at this point in time, done from about 2020. So it's even more expensive than this. So the average cost of a nursing home is $100,000 per year. And I'm going to tell you, it's probably more like 110 right now, being 2 years later. So this is not going to get any cheaper. It's actually going to get worse at an increasing rate. The largest segment of the population is baby boomers. Next up is the millennials, kind of an echo boom. But the baby boomers are the largest segment of the population. And the front end of the baby boomers born in 45 or 46, I believe. They are now in their mid to upper 70s. So we haven't had the baby boomers really go through the long-term care process. Some of them are starting to go into it, but that massive population going through that, nursing home, assisted living, needing adult care, we're just starting to enter into that. And the reality is there's just not enough facilities. There's not enough people in the industry. In fact, you'll notice that it's such a big potential that businesses, you'll notice there's a lot of, there's certain kinds of Marriotts or Hiltons or Hyatts cropping up and closer to neighborhoods nowadays, right? They're not the high-end Marriott. It might be a Marriott Fairfield Inn or a Hyatt Place or a Holiday Inn Express. And they're on the edge of neighborhoods. And the reason that is the case is those places are meant to be converted to senior living facilities within about 6 months of renovation. And companies are smart, and they saw this coming down the road, and they started doing this years ago with the idea of, hey, this is a lot of young people, younger people here, young professionals in this area. They're going to want their parents close, and they can move their parents in over here and stop by on multiple times, per day or per week and things like that. So I'm telling you, this is a major problem, and it's going to take planning on your part. Assisted living, you're looking at probably around $6,000 a month, 5 to 8,000, depending on your level of assisted living, but about we'll call it $6,000 a month for assisted living. And adult daycare or in-home care, well, that depends on how much you use it and what you're looking to do. Adult daycare would be a couple thousand a month. And then, in-home care, well, do you need a nurse once a week to come in, or do you need a nurse daily? And so, but again, having someone come to your house even on a daily basis is far cheaper, as you can see, than paying for assisted living or especially a nursing home. So how can you pay for this? Well, you can pay out of pocket. You can rely on government programs such as Medicare and Medicaid. And I'm going to tell you right now that for all of us listening, we're either middle class or upper middle class, and that is really not an option. All right. We all are worth too much money and make too much money. And I'm not talking about being rich. See, the thing about long-term care is if you're poor, you don't need really the coverage. Not only can you not afford it, but Medicaid will come in because you don't, you pay some money out of pocket and then Medicaid comes in and takes over. If you're rich, well, then, you might be able to pay some. You don't want to pay it out of pocket, but you can pay it out of pocket. If your long-term care costs are, $500,000-$800,000 over your lifetime, you can afford that. You don't want to, but you can. If you're middle class to upper middle class, well, you're too wealthy to get Medicaid. And at the same time, you don't have enough money. You don't want to go through your life savings to take care of you in a nursing home. God forbid you get dementia or Alzheimer's, where you could be in there for quite some time. So the niche for us, for probably everyone listening, I know I'm going out on a limb saying that, but the niche for most of us listening, being federal employees or having my own business, as being middle class or upper middle class, we buy long-term care. Okay, and the time to buy that is typically in your 45 to 55 range. Now, if you want to buy it as you get older, you can do that. We'll go over that in just a minute, the cost, but it does get more expensive as you get older. And what happens is when you do need care, it pays benefits to you to reimburse the costs. So it's a reimbursement kind of thing. You pay the costs out of pocket, you'll qualify for it, and then they pay you, and then you pay the facility to take care of that. All right. And the goal with this is to keep you in your home longer. Your coverage will last longer the longer you're in your house. So whether you go with the government program, which I need to say as of the moment I'm talking right now, the government program has now been suspended and is no longer available for about 1 to 2 years. I don't know the exact time frame, but is now being suspended. They're looking to redo the whole thing. It became the way they set it up just has not worked. The prices have continued to go up faster than industry. But in private industry, just because that's happened, just because the federal program's not available, doesn't mean you don't need to look into this, even in private industry. A lot of times private industry can be cheaper anyway. It's a little bit more of a headache to get into it, but it can be cheaper. Why? Because in the federal government, you answer 20, 40 questions, and if you're in, you get in. All right. As long as you don't have any of the big no-nos, they let you in. But the problem with that, though, is everybody might be a table C coverage. You might run marathons for a living, okay, and you're in outstanding health, but they let someone else who is in table D get in, and you guys are paying the same price, which means that you guys average the two costs together. In private industry, it's a little bit more of a pain in the neck, but you do your height, weight, blood, urine, all that kind of stuff. They look at your doctor's records. But if you're healthy, you get a lot cheaper cost, and you can even get couples discounts and things like that. So when you're looking at coverage, here's the things you want to look into. First thing is a daily benefit amount. And this applies to federal or private industry. What's the daily benefit amount? Every month has 30 days for when it comes to long-term care. It doesn't matter if it's 31, 28, whatever. They just say every month has 30 days, period. So if you get a daily amount, and most people do between $100 and $250 a day. So if you do $200 a day, if you the bottom left-hand column here, you'll see that that's $6,000 a month in coverage. Now, the goal with long-term care insurance is not to cover every last nickel of your long-term care. The goal is to be a supplement. Most of you can afford to pay, if you're going into a facility, most of you can afford to probably pay a few $1,000s, whether it's $2,000 or $4,000 or $5,000 a month. You can afford to pay some amount of money a month out of pocket for the long-term care without really affecting your nest egg. You can afford to pay some of it out of pocket. This is meant to be a supplement to that. So when you look at this, $200 a day is $6,000 a month. You're going like, well, I need $8,000 a month because $96,000. I need $10,000. That's $120,000 in coverage. Well, no, you don't. You can afford some out of pocket, and this is meant to be a supplement. That's important because you want this to be affordable now and in the future. The next thing you're going to do is you need to pick the number of months that you want coverage. Average person does 36 months. Maybe you want 24. In our family, for Michael and I, we end up outliving our usefulness. We end up having, Parkinson's, Alzheimer's, things like that. And we live a while, but we don't really know what's going on. So we might need more of a 5-year or 60-month policy. So maybe we get a little smaller benefit up front, but we may want to have something last 60 months. If your family's history is, cancer and heart attacks, well, then maybe you want a little bit more coverage, but a shorter benefit period. Now, here's the way the benefit period works is if you have a 36-month policy, that doesn't mean it only lasts 36 months. That means if they paid out $6,000 a month, it would only last 36 months. Most people don't need from day one $6,000 a month. The average 36-year policy lasts about 5 years. Okay, because you start out maybe needing $50 a day, and then it's $100 a day, and then it's $150, and then before you know it, unfortunately, you're paying your $200 a day. But your average 36-month policy will last about 60 months, is what statistics have shown over time. The next important thing we have to look out for is inflation. Inflation was dead for 20 years in this country, and we didn't worry about it. Life was good. Guess what's back and is all the rage these days? Inflation. And inflation, though, in healthcare has been around for quite some time. And based on the statistics I showed you earlier with the aging population of baby boomers, inflation when it comes to long-term care is going to be crazy, I believe. So looking at that, you need your $6,000 a month today at age 52. You need a way to make that increase because $6,000 a month by age 82 may not be that much coverage. All right, there's two ways to do that. You can either buy a huge policy, obnoxiously big, where you get $10,000 a month now. Maybe you do $400 a day, and then there's no inflation protection because you're buying future dollars today. Another way to do that is to buy today's dollars today, but then have it grow at a rate. Usually you pick 3, 4, or 5% is what you're picking from. Clearly, the faster it grows, the more money it costs. And then lastly, there's an elimination period. Elimination period is kind of a deductible. If you think of it, it's a time deductible. Most people pick 90 days. Why? Because if you go from a hospital to a nursing home, and most people do that. If you're going to a nursing home, a doctor needs to look at you. But if you go from a hospital to a nursing home, Medicare will pick up the first 90 to 100 days in the nursing home. But even if you don't, it's a lot cheaper to pay the first 90 days out of pocket and then have the policy to kick in. If you're going into a nursing home, it's most likely not the last 2 or 3 months of your life. It could be, but for a lot of people, the average stay is 1 to 2 years at that point in time. So 90 days out of pocket. Again, if your family history is that of once you get to the nursing home, you're going to be parked there for a while, then maybe you want to go out to 120, 180 days. Look at see if that offers that. Hey, I can afford the first 6 months out of pocket, but once I'm there, I'm going to be there a while. So I need this thing to last longer. So I'm going to save money by having a longer elimination period, but that's going to allow me to spend more money on the benefit period. Okay, you see how that all works? You want to play around with this kind of stuff. Talk to an expert. Again, we can help you. Someone else can help you, but someone who knows federal benefits. But they need to get into the details of your life. How much money do you have in your TSP? How much debt do you have? Do you have rental properties? What does that look like? Your family history. There is no one size fits all policy. All of it goes together to put together a policy that's tailored towards you and your family's needs. All right, let's look at a couple more slides and we'll be done here. Need to be in reasonably good health. You don't have to be in great health, but reasonably good, right? They still don't like the you can't have had cancer last year kind of thing, heart attack 2 years ago, or diabetic, things like that. Those are some of the big no-nos. Now, if you had maybe a heart attack many years ago and it was smaller and your health has been fine for some time. My wife, now 11 years ago, had breast cancer. She would have no problem. They might drop her 1 table, but they're not going to drop her a lot. She's been in 10 years now of cancer-free. So that kind of thing, it's pretty good. Premium is based on your age. So that's why I said typically between 45 and 55 is the time to buy this. As you get older, it just gets more expensive. Now just because you're 62 and listening to this, maybe you are, maybe you're not. But if you're 62 and listening to this, doesn't mean you don't need this coverage. This is the number one threat to your retirement, and you need to have a plan for it. All right. Before you say my kids will take care of me, be careful with that. Michael had to take care of his dad with Parkinson's because his dad was diagnosed at 48, and had to take care of his grandparents. And having your kids take care of you, you will lose your dignity. I'm telling you that. You don't want that to happen. So be careful. People say that my kids will take care of me, or they'll say something flippant like, well, just kill me or whatever, or just I won't go to nursing home. I want you to. Those are not realistic solutions. And by putting off solutions and by putting off choices, you're actually making a choice. This is not fun. This is expensive, but it is absolutely essential to protecting you and your family. All right. The way you trigger and you get paid out of the long-term care is if you can't do 2 of the 6, what they call ADLs, or activities of daily living. That's your typical transferring, trying to get across from one place to another. You need help getting out of bed kind of thing. Eating, someone prepare meals or eating, toileting, continence, those kind of things, showering, bathing. If you can't do 2 of 6 activities of daily living, then you qualify for money from your long-term care. Or if you're mentally, you're just not there anymore, or it's fleeting for you, then you can also, a doctor will write you a note saying, yes, this person qualifies for long-term care at that point in time. People will say, well, hey, I'll take that, $150, $200 a month or $250 a month, and I'll just pay that and save it on the side. This kind of shows that's really not a good solution. Now, if you already have the money saved up, then that's fine. But here's the reason why it's not a good solution. So this shows you if you save $3,000 a year and it grows at 5% after taxes, which means you're probably growing at 7% a year, a reasonable rate of return. You have $105,000. But all right, let's say you put more money in and you even do any better in the market. Let's say you save, I don't know, $200,000 over a 20-year period. Great. How long does the $200,000 last? Remember, we talked about that earlier when we showed you what the price is going to be in 2030. Okay. Now, if you were to spend that $3,000 to $4,000 a year on a long-term care policy, that's not fun versus putting it in an investment account. But now you're compounding at 5% a year, a larger nest egg. All right. You're compounding $250,000 for the next 20 years, all at 5% instead of growing it in the market from scratch. You now have $400,000 to $500,000 available to you for care instead of $200,000. So that's what policies do. So whether it's life insurance or long-term care insurance, is that they place the risk onto the insurance company that you need it earlier. If you don't need it earlier, then you have a bigger nest egg. But in this particular case, they're still going to pay it out if you need it. And then lastly, there are a couple other options like, well, I don't want to pay $3. What if I pay 80 grand into this thing and I never use it? Well, that's a possibility, not a big probability, but a possibility. If you want to pay a little bit more, you can get return of premium. And that means all the money you paid into it, well, then you name a beneficiary. Upon your passing, that money then goes to your beneficiary. So you can do that. Of course, it costs more money because the insurance company doesn't get to keep your money. Okay. They had the risk of paying all this money out. Let's say you made your first payment, then you needed long-term care. That's money. They lost money on this thing. But at the same time, someone doesn't need it at all. They paid $80,000 into it. You can, for spending a little bit more money, name a beneficiary and get paid out on that. All right, last couple of slides here. Make sure it's a reputable company, one with good credit rating. That's really important. Make sure whatever you choose now, the prices of your long-term care will go up over time. Life insurance really doesn't go up over time. They have a right to raise it, but life insurance companies don't really raise rates over time. Long-term care companies will raise your rates over time. I hate to say it, but they just will. Doesn't mean you can't buy it, but you need to make sure you can afford it now and in the future. Okay. If you buy private plan, if you buy the government plan when it comes online, as of right now, you don't get any tax breaks for it. But private industry, you can actually get federal and state tax deductions for it. And before you think, well, the government will take care of you with Medicaid, just so you know, Medicaid, you have to be down to your last $2,500 to your name. Or Medicaid will take half of everything if you're a married couple and put a lien on the house. All right. And upon the spouse's passing, they may come in, step in and take the remaining portion of whatever's left over. All right. Medicaid is going broke. The federal government gives money to the states. It is going broke. They're not going to be able to afford the baby boomers. I'm not a politician, so I don't have a good solution for them. I'm just stating the facts. And having said that, with what's coming up, I look for them to be more aggressive in taking money. And the 5-year look back period may become a lifetime look back period. Are you allowed to give money away? I don't know. It's who knows where this is going in the future, but you need to have a plan in place. All right, combination policies. These are my favorite. I just turned 50 last year. I don't have long-term care yet, but sometime in the next year or two, my wife and I are going to get long-term care. We are going to do this. I don't know if this is the best thing for you or not. What you can do with this is you can actually buy a life insurance policy with a long-term care rider. So you put money into the policy. You can do a large upfront sum. Let's say you put $50,000 into it upfront, or you can make monthly payments. It's a little bit more expensive to do monthly payments. Why? Because the insurance company doesn't have your money up front to invest from day one. But if you can do upfront payments, or you can send them money on a monthly basis. If you do paid up over 10 years, or if you do a large lump sum, then they can't raise the rates on you. That's the benefit of that, right? There's no raising rates because you paid into it. You're paid up at that point in time. So what you can do, let's say, as an example, don't hold me to these numbers. Let's say you put $50,000 or into a life insurance policy, just to kind of make up a number here. Upon your passing, that turns into a $120,000 death benefit. The whole point of this is not really life insurance, but if you pass, then you at least someone's getting $120,000 tax-free. If you need long-term care, let's say that $120,000 turns into $250,000 to $300,000 in long-term care if you need that. Now, if you start using long-term care, that money's subtracted from the death benefit too. Okay, so if you use $100,000 of long-term care benefits, only $20,000 is paid out and there's a death benefit at that point in time. So the combination, this is great. At the end of maybe a 5, 6, 7, 8 year period, it's growing in a fixed market, maybe 3 to 5, 6% nowadays. Who knows with the way interest rates have gone up? At 3 to 5%, you're getting tax deferred. And you know what? At the end of 5, 6, 8 years, if I want my buddy back, I get my $50,000 back plus interest. So if I live and I want my money back, I can't lose. If I die and I never used the long-term care, I can't lose. I parlayed my money into tax-free death benefit that I'm not going to enjoy, but at least someone will. I created wealth for my troubles. And if I need long-term care, that's an idea. So as of right now, unless something comes better on the market, this is what I look at using for my family. These cost a little bit more than a pure long-term care policy, but you're getting a lot more for it, and you can't lose your money. All right. The only way you lose your money, I guess, is if the insurance company were to go out of business. And that in America, we also have what's called the guaranteed insurance fund. So something like this were to happen where one would go out of business, other insurance policies would come in and eat them up and buy them out so they don't go out of business. The whole insurance industry is built on trust. All right. So there is a guaranteed insurance fund they all pay premiums into to make sure this stuff is around 30 years from now for you. Okay. Again, any questions with this that we've done? We've covered a lot. All right. Look at for all this stuff, long-term care, FEGLI. It takes an analysis. It takes talking to someone. You can do it yourself, but you got to do your own research. Assess your finances, your family, your plans. Not making a choice, not having a plan is making a choice and having a plan. You're just putting it off in the future. So one of my favorite people, Andy Stanley, says, we're all on the path somewhere. We're all going to end up somewhere. We're all on a path. The question is, are you going to get to where you want to be on purpose, or are you going to let life deal you cards and then you just kind of reacting to it? So again, this isn't really fun topics to talk about, but they're oh so important to your retirement and the success of your retirement. Okay. Any questions? With just a few of us on, feel free to unmute and ask questions if you have any questions. All right. Well, thank you for your time. I appreciate you being here. Hopefully you got something useful out of it. If you want to reach out to us, here's our information, but you can also reach out to Maya as well, and she will connect you with us. It's just something you're interested in. We are here to help. So thank you so much for your time and have a wonderful day. Thank you.